Yeah, thanks for pointing that out. Yeah, yeah. Sunk cost is just a past cost. So it's like water under the bridge, water over the dam, don't cry over spilt milk, stuff like that. Yeah, yeah. And you move forward. Past cost. This car cost me $20,000. So what effect does that have on whether I decide to travel from Boston to New York? Nothing, right? Yeah, what if it costs $15,000 instead of $20,000? Would that make a difference? No, because it's irrelevant for purposes of deciding how do I get to New York? Do I take a bus, a train, a plane, or a car? Well, it's possible, I guess. Two-step process in decision making. Step one, eliminate costs and benefits that do not differ between alternatives. If it costs the same, whether you choose option A or option B, it's irrelevant. I hear a voice. One of my online students want to say something? I hear a voice. Okay, so eliminate costs and benefits that are the same. Let's say that, well, we're going to run into some examples of this. If the revenue is going to be the same regardless of where you sell it, you can ignore that little bit of information. Step two, use the remaining costs and benefits that differ between alternatives in making the decision. Costs that remain are the differential or avoidable costs. Again, this is just for purposes of making decisions. I'm not saying that some information is never relevant. It's just for purposes of making decisions. Certain information is information that can be ignored. Costs that are relevant in one decision situation may not be relevant in another context. And thus, in each decision situation, the manager must examine the data at hand and isolate the relevant costs. There's basically two ways to do it. You can use what they call the aggregate approach, where you make a full income statement or cost sheet under an alternative one, alternative two, and you look at all the costs, all the revenues. That's called the aggregate approach because you're combining everything together. The other would be called the differential approach, where you just look at the items that make a difference. And we're going to see both of those. So in this example, Cynthia, a Boston student, is considering visiting her friend in New York. She can drive or take the train. By car, it is 230 miles to her friend's apartment. Whenever you see the number 230, what do you think of? 230? 230, time to go to the dentist, right? Okay. Just sometimes repetition is good. 230 miles to her friend's apartment. She is trying to decide which alternative is less expensive and has gathered the following information. The automobile costs, based on 10,000 miles driven per year, annual straight line depreciation on the car, $2,800. And if the car costs $24,000 and the salvage value is $10,000, remember from your financial accounting class we had salvage value? That's what you can sell it for when you're done using it, right? So the car was purchased for $24,000. She thinks she'll be able to sell it for $10,000 a few years in the future when she's done using it. So that's $14,000 to be depreciated. Divided by 5 years is $2,800 a year using the straight line method of depreciation. Cost of gasoline is 10 cents a mile. Annual cost of auto insurance and license, $1,380. If she drives 10,000 miles a year, that's 13.8 cents per mile. Maintenance and repairs, 0.065 per mile. Parking fees at school, 360 per year, 45 a month times 8 months. All of those costs are relevant, right? Yeah, the parking fees at school, she's going to pay that whether she takes the train or the car. Maintenance repairs.
So you're saying that's relevant?
No, it's not relevant.
Okay.
Yeah, that's just to throw you off. I guess it didn't throw you off because you caught that. Anything else there that's not relevant?
The insurance?
Yeah, the insurance, she's going to pay that whether she takes the car or the train.
Depreciation.
Yeah, what about depreciation? Now here's a good point, depreciation. This is based on the straight line method. It's based on time. If it's based on time, it's going to be the same amount whether she takes the car or the train. But what if depreciation is so much per mile? What about that? That would be relevant, yeah. If the depreciation method she chose were something based on miles, like 6 cents or 10 cents or 20 cents a mile, that would be relevant. But because it's based on time, the car is either going to be used or it's going to be parked. Depreciation is going to be the same if it's based on time, like the straight line method. So it's irrelevant in this example.
And I was saying the maintenance and repair, the car might need to be repaired regardless of either if you drive it or not. You may need to take it for repair.
Yeah, but if you drive it 230 miles or 460 round trip, you're going to incur, it's going to increase. Yes?
Can we have them mute that mic, please? It's driving me nuts.
The what?
The person,
Someone needs to
they're moving.
someone has a computer and they didn't mute their microphone, and so all the ambient noise is coming over the.
So how am I supposed to do that?
Just back to the video.
Turn up your,
Oh, could you, whoever out there in cyberspace who's creating noise, could you please turn off your microphone? Thank you. Nice. Yeah, I was wondering what that is. Whenever I hear stuff like that, I think someone's trying to say something. Feel free to unmute your microphone if you want to ask a question now. The fact that they turned it off means they must be able to hear me. That's good. So what do we have? Automobile costs based on 10,000 miles driven per year. The annual straight line depreciation, 28 cents a mile. Cost of gasoline, 10 cents a mile. Oh, those are the good old days, huh? 10 cents a mile. Annual cost of auto insurance and license, if it's 10,000 miles, $1,380 divided by 10,000 miles is 13.8 cents per mile. Maintenance and repairs, 6.5 cents. Parking fee at school, if you divide that by 10,000 miles, you get 0.036. So the total average cost, 61.9 cents per mile. The thing is, some of these costs are not relevant, and we've already sort of discussed which costs those are. And then we add this other layer of information that she might take the train instead. And here's some additional information. Number 7, reduction in the resale value of the car. Every mile you drive it, the resale value drops by 2.6 cents. So if she takes it from point A to point B, she's going to lose that way. That's a real cost. Round trip train fare, is that relevant?
if she's driving.
Not with the car.
Yeah, you have to compare what's the cost of driving versus the cost of Plan B, which would be the round trip train fare. So that's relevant.
Yes, any decision making.
And the benefits of relaxing on the train trip. You can't really put a value on that. That's why there are question marks. But there are some non-monetary either values or costs associated with that, like trying to find a parking place in New York. That's a negative, right? Or driving in New York is a negative, unless you like the thrill of driving in New York. Cost of putting the dog in the kennel while gone. Either way, she's going to be gone, so she's going to incur that cost either way. It's the same under both situations, therefore it's irrelevant for purposes of determining whether she takes the car or the train. The third option is, should I go? Maybe she doesn't want to spend $40 putting the dog in the kennel, either because she thinks the poor dog won't benefit or because the cost is excessive. But that's the third option, right? It's either go by car, go by train, or don't go. We're only considering two of those options. She's already decided to go. So for purposes of this decision, that $40 is irrelevant. Benefits of having a car in New York. Well, questionable. Depends on what borough you're in too, how close you are to a subway stop and buses and all that. So they just put question marks. Hassle of parking a car in New York. There's a certain hassle involved. Per day cost of parking a car in New York, 25. That's changed. Well, I guess it depends. In Manhattan, you can't get 25 a day, I don't think. Certainly not in Midtown. But that's okay. It's a number. We'll go with what they give us. So which costs and benefits are relevant in Cynthia's decision? The cost of the car is a sunk cost. Whatever it costs is irrelevant in terms of deciding should we take the car or take the train. The annual cost of insurance is not relevant. she's going to incur that cost whether she drives or not. However, the cost of gasoline is clearly relevant, because if she goes by car, she's going to incur the cost of gasoline. If she goes by train, she won't have that cost. So that's a differential cost because it's different under the two alternatives. The cost of maintenance and repairs is relevant. If she drives the car, it's going to wear it out a little bit. It's what, 2.6 cents a mile, something like that. In the long run, these costs depend upon miles driven. The monthly school parking fee is not relevant because she's going to have to pay that whether she parks it in New York or Boston or someplace else. At this point, we can see that some of the average costs of that 61.9 cents per mile are relevant and others are not. Then you just multiply it by 2 times 230 to get the total cost. But we have to whittle that 61.9 down a bit. The decline in resale value due to additional miles is relevant. It doesn't decline in value if she leaves it parked. The round-trip train fare is clearly relevant because she might incur that cost if she decides not to drive. Relaxing on the train is relevant, even though it's difficult to assign a dollar value. You could pick some number out of the air, but we're not going to do that here. The kennel cost is not relevant because she's going to put the dog in a kennel either way. So when the costs are the same between alternatives, it's irrelevant for decision-making purposes. The cost of parking in New York is relevant because it can be avoided if she takes the train. The benefits of having a car in New York and the problems of finding a parking space are both relevant, but are difficult to assign a dollar amount. So from a financial standpoint, she'd be better off taking the train. And here's one way to figure this out. Cost of gasoline, 460 miles. Where's the 460 come from?
Round trip.
Round trip. 230 times 2, 460 at 10 cents a mile. So $46 for gas. Maintenance, 6.5 cents a mile times 460. Reduction in resale value, 460 times 6.5 cents, or 2.6 cents per mile. Parking in New York, 2 days at 25 per day. So if she took the car, it would cost $137.86. Round trip train ticket is $104. So if you exclude all those other things, like the joys of having a car in New York and the hassle of parking and things like that. I mean, having a car is a certain convenience, but in some places, if it's difficult to find a parking space, a lot of people who live in New York don't have cars. No, they take a train or a bus, or a subway, or walk, depending. So, and you can pay $300 a month or more just for parking in New York, plus the cost of insurance. If you don't have a car, you can save. And the cost of insurance in Manhattan is pretty high. So here we have the total and differential cost approaches. This is one way you can structure something. This is a new example. The management of a company is considering a new labor-saving machine that rents for $3,000 per year. Data about the company's annual sales and cost with and without the new machine are: sales are going to be the same either way, 5,000 units at 40, so that's irrelevant for purposes of determining should they buy the machine. And variable expenses, direct materials, either way, it's going to be 5,000 units at 14 or 70,000. Again, it's the same under both alternatives, so that's irrelevant for decision-making purposes. Direct labor, here you're going to have a difference. Direct labor, the current situation or the situation with the new machine, 5,000 units at either $8 or $5. With the new machine, you can cut that by $15,000. So that difference is relevant. And variable overhead, that's going to be the same in both cases. Total variable expenses then would be different, 120 versus 105 because of this 15,000 differential here. And so the contribution margin would be different by 15,000. 80,000 under the current situation would be 15,000 higher if you decided to buy that new machine. And other things, fixed costs would remain the same in this example. The rent on the new machine is 3,000. You would only incur that if you rented the new machine. So it's 0 here and 3,000 there. So the total fixed expenses, a difference of 3,000. So the bottom line, net operating income, if you keep the status quo, Don't buy the new machine, 18,000. If you buy the new machine or rent the new machine, 30,000, a difference of 12,000. So what should you do? Should you rent the new machine? Yes. This is called the aggregate approach because it shows everything, the relevant information and the irrelevant information. The aggregate approach. Aggregate means everything combined. The incremental approach, or the differential approach, would be just looking at the 15 and the 3. Much easier. What would Occam say? I mentioned Occam before, O-C-C-A-M. What did I say about Occam? What famous theory is he famous for? Let me rephrase that. Who is famous for coming up with the theory of Occam's razor? Occam, exactly. Medieval philosopher. He said if there's two ways to do the same thing, do the easier way. If you can slice out, take a razor and slice out the irrelevant parts. The irrelevant parts here would be the 200,000, 70,000, 10,000, and 62,000, and so forth. In other words, he would advocate using the differential approach instead of the aggregate approach if he were here. But he's not. I guess he's vacationing in the south of France or something. Or maybe he died 500 years ago, one of those. But anyway, Occam's razor, if there's two ways to do something, do it the easier of the two ways, all other things being equal. So you can use the differential approach. It's easier, it's faster, it takes up less time, less space. However, if you don't feel comfortable using the differential approach, don't use it. Use the aggregate approach. The nice thing about the aggregate approach is that it shows everything, all the revenues, all the costs. That's the advantage of the aggregate approach. It shows everything. What's the disadvantage? It shows everything, including stuff that's irrelevant. The nice thing, the advantage of the differential approach, where all you show is the 15 and the 3, is that it highlights what the differences are. The disadvantage is it may not be easy to determine right away what's relevant and what isn't. Some people feel uncomfortable using the differential approach or the incremental approach. So two ways to solve this: use a method that you feel more comfortable with. If time is not a constraint, do it both ways and see if you come up with the same answer. If you don't, you made a mistake. It's a good way to check your work. So you can get 100 on my quizzes instead of 90. People did well on the quizzes, by the way. I mean, you know, you get 20, 40, and 100, you got 100. So you only need to get it right once. Exam 2 is a little different, though. You know, some people don't do as well when they don't have the book, which is understandable.
So you make
And the professor present, that makes.
Oh, I do make a difference in a positive way? Well, thank you.
It makes me nervous.
Is that test going to be told
Pressure, right?
for McGraw as well?
Yeah, all the exams, first, second, and third, all come from the materials provided by McGraw-Hill. Yeah.
So
Does that make a difference?
6 on, right?
Yeah, I'm taking it from my same secret professor source. Except it's not too secret because I just told you where I'm getting my stuff. Yeah. Okay, so as you can see, the only costs that differ between alternatives are the direct labor cost savings and the increase in the fixed rental cost. So this is the, again, the differential approach. 15 minus 3 is 12. Here it highlights it, whereas before it was in that extreme right-hand column. It's two ways to look at the same thing. This highlights differences, and you ignore all that other stuff that's irrelevant. If you're doing an exam that's where there's a time constraint, if you understand both methods equally, the aggregate and the differential approach, you can save time by just doing this. Ignore all the stuff that doesn't count. Using the differential approach is desirable for two reasons. Only rarely will enough information be available to prepare detailed income statements for both alternatives, and mingling irrelevant cost with relevant costs may cause confusion and distract attention away from the information that is really critical. So just ignore the irrelevant stuff, in other words. Second learning objective, prepare an analysis showing whether a product line or other business segment should be added or dropped. Businesses run into this stuff all the time. You know, if you're making profits, you would keep it. If you can increase your profits by adding something, you add something. If one of your segments is losing money, then you drop it, you get rid of it. The question is, are they really losing money? What's maybe the number one reason why someone would make an incorrect decision about dropping a segment?
Not knowing that they're making a wrong decision.
Yes, not, okay, I can't fault you on that one. Yeah,
Their profits not,
hmm?
their profits not hitting correct.
Yeah, the profits. It may look like it's losing money on paper, but maybe the reason it's losing money is because you're taking a deduction for fixed costs that you're going to have anyway. Let's say you have a factory with 10,000 square feet. You produce 10 different products. They each take 1,000 square feet of the factory. One of those products is losing money. Of course, one reason it's losing money, you're deducting 10% of the rent and arriving at that negative bottom line. If you eliminate that product, you're still going to have to pay the same amount of rent. The landlord's not going to give you a 10% discount because you're only using 9,000 of the 10,000 square feet. You're still going to have to pay 100% of rent. So that's a cost you're going to have anyway. So if the cost would be the same under either alternative, whether to keep the product line or not, that becomes an irrelevant cost when you're trying to decide, should we get rid of this product line? So let's take a look. Contribution margin approach. Decision rule. Here they sort of tell you in advance, they're sort of setting you up for the fact situation here. Lovell should drop the digital watch segment only if its profit would increase by dropping it. Lovell will compare the contribution margin that would be lost to the cost that would be avoided if the line was to be dropped. So one of the most important decisions managers make is whether to add or drop a business segment. Ultimately, the decision to drop an old segment or add a new one is going to hinge primarily on the impact the decision will have on its operating income. So basically, the way you do this is you make an income statement where you have two columns, one for the current situation where you have the product line, and then another column where you don't have the product line. And the revenues would change because if you don't have a product line, you're not going to be able to sell any units, so the revenue would become zero. You could also avoid all the variable costs and maybe some of the fixed costs, like the manager of the segment or the supervisor for that segment. If you don't make that product, you don't need that person. Maybe fire that person, maybe send him or her somewhere else to do something else. So some fixed costs can be avoided. You'd lose all the revenue, but you would also not incur any of the variable costs, and you might save some fixed costs as well, but not all of them. Your rent would remain the same probably. To assess this impact, it is necessary to carefully analyze the costs. Due to the declining popularity of digital watches, Lovell Company's digital watch line has not reported a profit for several years, and they're thinking about getting rid of that product line. So let's see the numbers. It looks like they're losing $100,000 a year. They have sales of $500,000, variable costs for manufacturing and shipping and commissions, leaving them with a positive contribution margin of $300,000, but their other costs, their various fixed costs, are $400,000. So they're losing $100,000. If they dropped this product line and they just didn't sell digital watches anymore, their revenues would decline by $500,000. How much would they be able to save in fixed costs? They'd be able to save all of these variable costs, right? Because if you don't make digital watches, you don't have any variable costs. Some of these they might be able to save. General factory overhead, if that's allocated, they'd have that anyway. Salary of the line manager, could they get rid of that? Yeah, if you don't have a product, you don't need the line manager, so you can save $90,000 there. Depreciation of equipment. Yeah, you're not using the equipment, but would it depreciate just sitting there too?
Yeah.
Yeah, it would. You'd still have it.
Get rid of it.
Well, that would be a complicating factor, right? Let's say that this equipment is only used to make digital watches, they can sell it for $10,000. Would that be a relevant number?
In a decision-making,
Yeah.
because it allows you.
Yeah, in one case, they'd sell it, they'd have a 10,000 cash inflow, one-time inflow, but if they keep making it, they wouldn't have that inflow. So it's different between the two alternatives, therefore that would be relevant if they had machinery that they would sell if they got rid of this product line. That's not in the fact situation, but if it were, you'd know how to handle it, right? Because it would be relevant. Advertising, direct advertising for these digital watches, that's a fixed cost. Could you get rid of that by getting rid of the product that you're advertising? I deliberately framed it that way to make it obvious, right? If you get rid of the product you're advertising, there's no need to advertise it. So even though this is a fixed cost, that $100,000 for advertising, we could get rid of that. And rent on the factory space, you're going to have to pay the rent anyway. So you're going to keep that. That's irrelevant, right? Because it's the same between alternatives. If you discontinue it or if you don't, you're still going to have to pay $70,000. Then general administrative expenses, you're going to have those anyway unless there's some reason not to. So let's take a look at the fact situation. Ooh, they conducted an investigation. An investigation has revealed that the fixed general factory overhead and fixed general administrative expenses will not be affected by dropping the digital watch line. So they'd have those either way. The fixed general factory overhead and general administrative expenses assigned to this product would be reallocated to other product lines. So in other words, they would still have to incur those costs even if they got rid of the digital watches. The equipment used to manufacture digital watches has no resale value or alternative use. So they can't sell it and get some kind of cash flow coming in. What kind of cost would that be? Maybe begin with S. Sunk. It's a sunk cost. Sunk costs are always, fill in the blank. You're giving me a correct answer, but it's not the one I want. Yeah. Sunk costs are always past costs. That's right. They're also always irrelevant for purposes of Chapter 7. Yeah, that's the thing. I should give you more hints, right? Like it begins with some.
When it comes to, or, you know,
yeah, or even give you the first letter of the word I'm looking for. Should Level retain or drop the digital watch segment? Well, we have to do some number crunching, but they're relatively small numbers. If you get rid of the product line, you don't have that $300,000 contribution margin anymore, which consists of the revenue minus the variable cost. So you lose $300,000 contribution margin. How much would you gain by getting rid of the product line in terms of costs? Well, the variable costs are already included in that $300,000, right? Because it's revenue minus variable cost, $300,000. So you get rid of that. So the fixed cost, the salary of the line manager, you don't need a line manager if you don't have a product. The advertising, you don't have to advertise if you're not selling the product. And that factory space, if you're renting the factory space, you could, unless it's all in the same building, that's another thing. Let's say that they have a digital watch factory where that's all they make is digital watches, you wouldn't have to pay the rent. But let's say you have 20,000 square feet and this takes up 3,000 of that, you'd still have to pay. So whether rent is relevant or not depends on how the rent is being paid. Here, it looks like it's relevant. They could quit renting that space. So you're losing 300,000 contribution margin. You're only saving 260,000 in cost, fixed cost. So you're really 40,000 behind. So if you're losing 100,000 now, how much would you lose if you got rid of it? 140. Yeah, you'd lose $40,000 more. So remember, the bottom line was a negative 100,000. It looks like you're losing money. The obvious answer, the no-brainer, as they say, is that you should get rid of that product line because you're losing 100,000. But if you got rid of it, you lose 140,000. So you don't get rid of it. Tricky stuff, huh? Yeah, there's a lot of these no-brainers that turn out to be brainers. And this is one of them. You know, the bottom line's a negative 100,000. The obvious answer is get rid of it. But that's not the right answer. The right answer is you're going to lose 140,000 if you get rid of it, so don't get rid of it. It's better to lose 100,000 than 140,000. That's why vice presidents don't like accountants. Well, that's one reason.
On Mondays, they teach us economy, the opportunity concept.
Good. Yeah. I stole that concept from economics, actually.
And then you can spend that $260,000 doing something else that might yield better.
Yeah.
The extra space to do
Yeah.
something else.
Yeah. If you could use that space to generate 500,000 in contribution margin and only 20,000 in cost or something.
I know that's probably your arch enemy, the econ professor.
No,
You
I,
speak to relatives.
oh no, I would have been an econ professor, except it would cost me 30 or 40,000 a year to be an econ
I
professor.
get what you did there.
That's, yeah.
Anyway.
I've taught econ as like an adjunct just because it's a lot of fun, you know. You can set up the class so that they think they know the right answer, and then you just give one little bit of information, and it's 180-degree turn. It's a lot of fun to do that.
You enjoy that.
Oh yeah,
You do it
From
here
your
too.
perspective, that's
I
fun.
do it here. This is, they call that psychic income. The IRS hasn't found a way to tax that yet. Yeah, I do it here, but I can do it even more in econ. But I taught econ at the Copenhagen School of Business for like 4 or 5 summers. They have a special class where they bring in students from all over the world. I can lecture in English. It's a big relief because they'd have to have the Danish dictionary in front of me all the time, you know. So yeah, so I taught econ there. They let me teach it there, macro and micro. Yeah, it's good stuff. I don't know which I like better because they're both really pretty good stuff, you know. Yeah, but that was just something to do in the summer. So I got a free vacation, except I had to teach like 3 hours in the morning. But I had 21 hours left to do other stuff, like ride a bicycle around Copenhagen. Which brings us to the comparative income approach, first of 6 slides. The level solution can also be obtained by preparing comparative income statements showing results with and without the digital watch segment. So let's look at this second approach. Here you have all the numbers. This would be called the aggregate approach because everything is aggregated together. One column, you keep the watches, you have sales of 500,000, you have a contribution margin of 300,000, and it looks like you're losing 100,000 in terms of net operating income. It's negative, net operating loss. If the digital watch line is dropped, the company loses 300,000 in contribution margin, but they also don't have to incur some of those fixed costs as well, like the 60,000 general factory overhead. That would be the same under both alternatives, therefore it's irrelevant. And the salary line, the salary of the line manager, that is relevant because if they get rid of the product, they get rid of the salary. They don't shoot them. They just, you know, give them a few weeks notice or send them to work on another product or something. They tell you a story about this one this publishing company I used to work for. I was editing a few journals and stuff. They wanted to expand, and so we had this directive from on high that every month we had to come out with a new journal. A lot of them failed. So we hired people to make this new journal, and then when it failed, we would fire them. Then the next month, we'd make another journal. We'd hire some of them back, but not others. So there were always ads in the paper. That company had a reputation for hiring and firing. So after the word got out, they had trouble getting people. Because when a journal went under, sometimes they wouldn't have anything to do. So I was safe because I managed like a half a dozen of them, and 3 or 4 of them were always healthy at any given time. But I didn't do the firing myself. My boss did the firing. So anyway, okay. So the same thing with this. Sometimes these people get fired, and sometimes they're just assigned to other magazines or something. Depreciation, it depends on what you're going to do with it. In this case, there's no difference, so it's irrelevant. Advertising, no need to advertise if you don't have the product line. And rent for this factory space, if you can get out of the rent by dropping the product line, then it becomes relevant. And so there's a difference there of 40,000. So you either lose 100,000 or you lose 140,000, depending. If you keep it, you lose 100,000. If you get rid of it, you lose 140,000. This is the aggregate approach. What's the advantage of the aggregate approach?
You see everything.
Yeah, you see everything. It's all right there in front of you. The differential approach, you only see the stuff that matters. It doesn't take up as much space. It's easier to see. So there are advantages and disadvantages to both approaches. Here we have the beware of allocated fixed cost slide. We've run into this before, right? Allocated fixed costs, like my example about the trust department of the bank in beautiful downtown Youngstown, Ohio. Can you put beautiful and Youngstown in the same sentence? I just did, I don't know. So anyway, why should we keep the digital watch segment? It looks like it's losing 100,000. Well, if we look at those common fixed costs, we're going to have some of those anyway. So the mere fact that they allocate it doesn't mean it has any effect on keeping or not keeping the product line. If you're going to have the cost anyway, it's irrelevant for purposes of answering the question, should we discontinue? Prepare a make or buy analysis. You can either make the stuff yourself or you can buy it from someone else. Is there a word for that when you buy it from someone else? Maybe begin with O?
Outsource.
Outsource, yeah. Outsource has developed an certain evilness about it, right? Did we go over that before? There's nothing inherently wrong with outsourcing. Like General Motors outsources its mufflers. General Motors doesn't make its own mufflers. They buy them from a muffler factory a couple miles down the road. It's in America, so that's okay, right? What if we're in the Philippines? Would that be still okay? Well, if you're a shareholder of General Motors, you'd say, of course, right? It helps the bottom line. If you're the worker who makes the mufflers, maybe you'd have a different opinion. I just throw that out to confuse you, just in case you think you understand the material. It's another psychic income thing. So the definition, when a company is involved in more than one activity in the entire value chain, it is vertically integrated. Like if you have an automobile manufacturer, wouldn't it be nice to have your own steel mill? So you could have a supply of steel, make it the way you want. Why not have a mine so that you can produce the steel? You know, you have whatever steel is made of, iron ore, and then some other stuff, other ingredients, coal and stuff. What if you had a bauxite mine? What would you make out of bauxite?
Yeah, what I do?
A bauxite mine. A mine that you dug bauxite out of the ground. What would you be digging?
I don't even know what bauxite is.
You make aluminum out of it. Except in England. In England, it's not aluminum. What is it in England? Aluminium. Yeah. We can say it in 4 syllables. They say it in 5. Occam's razor again, right? Same thing. Aluminum or aluminium. Right? We can save 20% by slicing off that extra syllable. So again, we have a make or buy decision. Adam Smith, you've heard of him, right? He wrote a book called The Wealth of Nations. When did he write it? Same year as the Declaration of Independence. When was the Declaration of Independence written?
1776.
Yeah, 1776. It's the same year Adam Smith wrote his book, The Wealth of Nations. They call him the father of economics because he's the first one to systematize economics as a science. He just put together a lot of ideas other people had been talking about for 1 or 2 generations before, but he got the label father of economics because he's the first one to put it together between 2 covers. Everybody else just talked, but he wrote. That's why he's the father of economics instead of David Hume, who said the same thing 20 years before. That's not on the CPA exam. So anyway, Adam Smith said, you should do what you do best and trade for everything else. So if you can make something cheaper, do it. If you can't, buy it from somebody else. Let's forget about borders here. You know, about buying stuff from China, Philippines, Vietnam. Forget all that stuff. Just do what you do best, trade for everything else. All other things being equal, which they are in chapter 7. Vertical integration advantages if you can control all phases of the operation. Like if you're an automobile company and you make your autos out of steel or plastic, whatever they make them out of these days, and you control the plastic factories, the steel plants, and the raw materials for steel, you have less problems, fewer problems. So it's a smoother flow of parts and materials because you control all phases of the operation. Better quality control, you can tell them how to make the steel. You can check to see that they're making it correctly, your specs and so forth. And maybe you can realize more profits because you not only have an auto company, you have a steel company, and you have a mining operation, and they're each profitable. There are some disadvantages. Companies may fail to take advantage of suppliers who can create economies of scale by pooling demand. Yeah, let's say you have a factory that can make 6 times as much stuff as you need. Do you want to make it yourself? You'd only be operating at 1/6 of capacity. Maybe you'd be better off buying stuff from a company that's operating at 80 or 90% capacity. They can pass on part of those savings to you because they can spread their fixed cost over more units. So in that case, you may be better off buying from someone else because of economies of scale. While the economies of scale factor can be appealing, should I discuss what economies of scale is? It's an economics term. It just means you're spreading your cost over more units. You know?
Well, isn't a variable is, if I'm making all this, it depends on what I want to sell it to for. You know, they don't talk about that, but that's a variable. Just because I make a bunch of them, I'm going to sell it to you cheap. I may be a hog agree to say, you know what, you got to come to me no matter what to make your product. Man, that's what that confuses me with economics and sometimes accounting is I throw in the variable of life, you know, versus just, you know, what I'm looking at, and that gets me every time in the wrong direction, unfortunately.
Yeah. Yeah, there's a lot of
thing I'm going to share with you.
Yeah, thanks. And share with them too. Yeah, there's a lot of stuff to bring into this, but you know how to compute unit cost, right? It's just total cost divided by number of units. Total cost, though, consists of 2 components, variable and fixed. The more units you produce, the lower your unit fixed cost. And so that's called economies of scale because you're spreading those fixed costs over more units. That's what economies of scale is. So if you have a factory that has so much productive capacity, you can make 6 times as much as you need. You either have to sell 5/6 of your production to somebody else, or else your unit fixed costs are going to be sort of through the roof. So if you can find a company that's operating closer to full capacity than you are, you might be able to get a lower price rather than trying to make it all yourself. So here's a make or buy decision. Essex Company manufactures part 4A that is used in one of its products. The unit product cost of this part is for direct materials, that would be a variable cost, $9. Direct labor, we'll assume that's variable. Variable overhead's variable. Depreciation of special equipment, they break this down into $3 per unit. Supervisor's salary, $2 per unit. General factory overhead, $10 a unit. So the unit product cost, when you add all that up, it's $30. Any problems with that analysis? Looks pretty good. It adds up to 30. How can you criticize that, right? Are some of those costs fixed? Yeah. Depreciation is probably fixed. Supervisor's salary is fixed. General factory overhead is probably fixed. I say probably, they didn't give us all the information we need, but so that $10 for general factory overhead, that's because you're spreading it over a certain number of units, but it's not really a unit cost. That unit cost could be 5 or 20, depending on whether you produce twice as much or half as much, right? The thing that's $10 here could be 5 or 20.
So why do they include the fixed cost?
Well, the reason they do it is to show you what mistakes you can make if you do this. Sort of. That's the short answer. Yeah, beware of unit fixed cost. Remember that a few slides ago? Now we're going to see why we have to beware of unit fixed cost. Depends on your volume of activity. The special equipment is used to manufacture part 4A and has no resale value. Is that relevant information? No resale value? Yeah, because it's a sunk cost in that case, right? It's not like an investment where you can sell it and get cash inflow. It's a sunk cost because it has no resale value. The total amount of general factory overhead, which is allocated on the basis of direct labor hours, would be unaffected by this decision. So that looks like that's a fixed cost too. The $30 unit product cost is based on 20,000 parts produced each year. What if they produce 40,000 parts a year? What's the unit product cost then?
You'd have to look at those three fixed variables.
Yeah, you'd have to look at the fixed and the variable stuff, but it would be less than 30, right? If they produce 40,000 units, that 30 would be something less than 30. If they only produce 10,000, it would be more than 30, because you're allocating fixed cost over more or fewer units. An outside supplier is offered to provide the 20,000 parts at a cost of 25. This is what they call a no-brainer, right? It's costing you 30, you can buy it on the outside for 25. Therefore, you should obviously buy it outside. Everybody agree? You can not only see that I'm setting you up, you can feel that I'm setting you up, right? Well, yeah, that's the thing. What are you going to do with the equipment if you don't need it? You can't sell it. It has no other use. Pay someone to take it away. Maybe. That's a cash outflow. Yeah. So the obvious answer is not always the correct answer. And this is a great example of that. Costs you $30 a unit to make. You can buy it on the outside for 25. Obviously, buy it on the outside. Except it's not obvious because some of those fixed costs that go into the 30 we're going to have anyway, and some we can avoid. So let's look beneath the surface to see what's going on here. So here we have the cost per unit. The outside purchase price, $25. The dire material, I think that should be direct. Maybe, I was going to say maybe they left off the CT, DIRE for space constraints, but there's a lot of space here, dire labor.
Then they'd have to be consistent.
Yeah, consistency is an attribute for accountants, by the way, right? Consistency, yes. So dire labor, or maybe direct labor, and so forth. Here, the cost of making 20,000 units, 180,000 for direct materials. Again, that's 20,000 times 9. Direct labor, again, 20,000 times 5. Variable overhead, 20,000 times 1. Depreciation of equipment, for the cost of those 20 units, again, that's going to be, they won't have that equipment. Supervisor's salary, well, 20,000 times 2 is 40,000. Is the supervisor's salary 40,000? Well, maybe. But again, this is a sort of funny number because all it was 40,000 divided by 20,000 is 2. That's where they came from. If the level of production was something else, this would be something else. So that's why they say beware of unit fixed cost. That $2 is something we have to be aware of because all it is 40,000 divided by 20,000. If that were 10 or 15 or 35,000, this would be different. And that would throw up our calculations if we don't watch ourselves. And then general factory overhead.
So then that makes it not fixed.
Well, it's still fixed. We're just allocating differently.
But not, I mean, it's fixed because the salary you will pay, but the amount is different fixed amount. If I can say it that way.
Well,
depending on how much the unit, that would change, like you said. I'm just trying to.
Well, this would change, and that would change. The 20,000, if it's 15,000 instead of 20,000 units, if it's 30,000 instead of 20,000, that would change, and the $2 would become something else. But the supervisor is going to get 40,000 regardless of production.
Okay, so that's no mistake, but those change.
Yeah.
They will always be 40,000.
Yeah, yeah. Regardless of the level of activity, the supervisor is going to get 40,000. Unless you discontinue that product line, then the supervisor gets nothing. If you buy 20,000 units, the supervisor doesn't get anything there. The supervisor will be canned, dismissed, or transferred or something. But the outside purchase price, 20,000 units times 25, $500,000. So again, it looks like it's costing you $30 a unit. You can buy it on the outside for 25. So it looks like you should buy it from the outside. But some of these costs you're going to have anyway. So the avoidable costs associated with making this part 4A include the direct materials. If you buy it on the outside, no need for direct materials, no need for direct labor, no need for any of these variable costs, a variable overhead, and the supervisor's salary. So those are 4 differences right there. Direct material, direct labor, and the variable portion of overhead, plus that fixed cost for the supervisor's salary. You can avoid those. So let's look at the numbers after we take those things into consideration. Under the options, again, make or buy. If you purchase it on the outside, it costs you $400,000. If you make it yourself, it only costs you $340,000. You're saving $160,000. The difference between the $340,000 and the $500,000, you save $140,000 by making it yourself. Even though your cost is $30 a unit and the outside cost is $25, when you take all these differential things, those four things that are different, the three variable costs plus the supervisor's salary, you're actually saving $160,000 by making it yourself. So is this a trick question? Well, if we do 2 or 3 of these, it won't be a trick question anymore. But that's why I say it was a no-brainer. Buy it for $25 and save yourself $5 a unit, but it's not. Questions, comments? Yeah? Is this good stuff or what? Maybe or what? So what's this all about? Oh, they just tell us the same thing I just said. The general factory overhead is not avoidable, therefore it's irrelevant. If the product is dropped, they're going to allocate that factory overhead to somebody else. And should we make or buy? Given that the total avoidable costs are less than the cost of buying the part, Essex should continue to make it. That way it costs them $340,000 instead of $500,000 or $160,000 ahead. Here we go, opportunity cost. Every class has opportunity cost, right? Of course, the mere fact that you're here means you'd rather be here than anywhere else, or else you wouldn't be here. That makes me feel good. There's no place you would rather be. An opportunity cost is a benefit that is foregone as a result of pursuing some course of action. Opportunity costs are not actual cash outlays and are not recorded in the formal accounts of an organization. You don't always know what you would do if you had another option. You can only guess. Nice thing about these textbooks, they tell you exactly how much you could win or lose. Prepare an analysis showing whether a special order should be accepted. We spoke about this a few weeks ago. You know, let's say you have an operation, you're making furniture in North Carolina. Somebody comes to you from Kansas and said, we'd like 500 tables, but we'll only pay you $50 instead of your regular $70. Should you sell it to them anyway? You're not going to affect your market in North Carolina because they're in Kansas. As long as nobody here in North Carolina hears that you're selling it cheaper anywhere else, you won't have to give them the same price. The question is, should you? What's the minimum price you can accept without losing money? That would be the break-even point. So a special order is a one-time order that is not considered part of the company's normal ongoing business, like people want to buy stuff from Kansas. When analyzing a special order, only the incremental costs and benefits are relevant. Or, in your economics class, I would say the marginal revenue is marginal cost, right? Since the existing fixed manufacturing overhead cost would not be affected by the order, they are not relevant for purposes of determining whether you should say yes or no to this offer. Here's an example. Jet Inc. makes a single product whose normal selling price is $20 per unit. A foreign distributor offers to purchase 3,000 units for $10 per unit. That doesn't sound like a good deal. They get 20 from everyone else. This foreigner wants to give you 10. This is a one-time order that would not affect the company's regular business. Annual capacity is 10,000 units, but Jet Inc. is currently producing and selling only 5,000. So they're operating at 50% capacity. If they took this order, they'd be operating at 80% capacity. They'd be able to take the order in the sense that they have enough excess capacity to do it. The thing is, could they produce it for less than 20 a unit? They can sell it for 20. If they can produce it for less than 20, they should take the order, all other things being equal. So should they accept?
You mean if you can produce it less than 10?
Did I say less than 10?
You said less than 20, should it be less than 10?
Yeah, less than 10. Yeah. No, I might also mention, maybe I pointed this out before, When it appears that the professor's made a mistake, it only means I'm testing you to see if you're paying attention.
You're right.
Yes, I mentioned that from time to time. And this is one of those times, right? They're going to pay you $10 for this. If you can produce it for less than 10, you should accept the order, all other things being equal. So what do we have? Revenue, 5,000 units of 20. This is under the contribution format approach. Then you have direct materials, direct labor, manufacturing overhead, and so forth. So 40,000 divided by 5,000. 40,000 divided by 5,000. That's your $8 variable cost. All other things being equal, then, if you can sell it for 10 and it only costs you 8, you should take the order because you're making $2 in every unit times 5,000 units is $10,000. Unless there's something else going on. So 100,000 minus 40, 60,000 is your contribution margin. Then the fixed costs, manufacturing overhead, marketing, and so forth, 48,000. So net operating income would be 12,000. And it was 10,000 before. So now it's 12. If JET accepts the special order, the incremental revenue will exceed the incremental costs. In other words, the net operating income will increase by 6,000. This suggests that JET should accept the order. So the increase in revenue, 3,000 times 10, and the increase in cost, 3,000 times 8. So the increase in net income is 6. Where did that come from? Where did the 3,000 come from?
Where are you saying 3,000?
The amount of
That's how many units?
Yeah, they're going to buy 3,000, right? Yeah, they're operating. Yeah, they're operating at 50% capacity. They have the capacity to produce 10,000. They're only producing 5,000. This company wants to buy 3,000 more units, so now they're producing 8,000 instead of 5. So they can increase the net income by $2 a unit. Variable costs are 8, they're getting 10. So they're making $2 a unit. $2 times 3,000 units, $6,000. That would be the incremental approach, where you don't have to look at all the numbers. Again, assuming fixed costs are unavoidable and that variable marketing costs must be incurred. No marketing costs. Yeah, if there's some kind of a commission, that would be a variable cost too. That could be included in the contribution margin if they had a commission. Oh, a quick check. This sounds like a quiz question. Northern Optical ordinarily sells the X lens for $50. The variable production cost is $10. The fixed production cost is $18 per unit. Should we be aware of one of those costs? Which cost should we be aware of? The 18, right? The fixed, yeah. The reason it's 18 per unit is because they're spreading those fixed costs over a certain number of units. If they produce more units, that 18 is going to become something less than 18. So the fixed production cost is 18 per unit. Be aware of that unit fixed cost. And the variable selling cost is $1. The customer has requested a special order for 10,000 units of the X lens to be imprinted with the customer's logo. This special order would not involve any selling costs, but Northern Optical would have to purchase an imprinting machine for $50,000. So should they do it? Are they going to be able to use the machine for anything else afterwards? If the answer is no, then they're going to have to absorb that full $50,000 cost with this special order. What is the rock bottom minimum price below which Northern Optical should not go in its negotiations with the customer? In other words, what's the break-even point? At what price could they sell it so they don't either lose or gain money? Which is what they said in the next sentence. There's ample idle capacity to fulfill the order, so you don't have to say no to any of your existing customers because you have enough excess capacity. And the imprinting machine has no further use after this order, so you're not going to be able to sell it and get some cash inflow. There's no alternative usage. So it's 15. So where did that come from? Well, you have the variable production cost, 100,000, the additional fixed cost of 50,000 because you have to buy that machine. So the total relevant costs are 150,000. You're going to produce 10,000 units, so that's $15 per unit. So if they sell it for anything more than that, they're going to be making money. And another learning objective, determine the most profitable use of a constrained resource. Constrained resource, what's another word they use in the book for that? Constrained resource? They begin with B, O, bottleneck. Yes, bottleneck. Bottleneck. Yeah. Yeah, let's say you make two products. You, let's say, oh, I'll just make some stuff up. Let's say tables and chairs. Here's an example you'll probably never get in the book, right? Tables and chairs? Or is there one in chapter 7? Tables and chairs.
You're testing us. I read the chapter.
It is in there, yes.
That's what
Yeah, for every table you have 4 chairs or 6 chairs, 8 chairs, whatever it is. You may have to make tables that don't have chairs or chairs that don't have tables or something. Now, let's say you can only work your workers 40 hours a week, or you can only get 2,000 board feet per month or whatever, but you have enough demand for 2,200 board feet worth of stuff, either tables or chairs. Which one do you make? Do you make as many tables as you can and then chairs with whatever you have left? Or do you make as many chairs as you can and then just make tables with whatever lumber you have left? There's a way to figure that out.
It also depends if they're complementary products.
Yeah. Throw that monkey wrench into it. If they're complementary products too. Because if they're complementary products, you know, buying some means you're going to have to, or selling some means you're going to have to sell some of the other stuff too. You could say, we'll give you the chairs this week, but we can't give you the table till next month. That's for the sales staff to do. Or we can lend you a table or something. So if you can't sell them the whole thing, but we don't go there. That just complicates things. This is complicated enough, isn't it? This, no, not too easy. I should ramp it up a bit. So when a limited resource of some type restricts the company's ability to satisfy demand, the company is said to have a constraint. Maybe they don't have enough board feet to cover all the tables and chairs they're going to make. Or maybe not enough time. Machines can only run 24 hours a day. The machine or process that is limiting overall output is called the bottleneck. It is the constraint. Fixed costs are usually unaffected by these situations, so the product mix that maximizes the company's total contribution margin should ordinarily be selected. The company should not necessarily promote those products that have the highest unit contribution margins. Well, that doesn't make sense. Can you explain that to me? The company should not necessarily promote those products that have the highest unit contribution margin? I thought you should promote the products that have the highest contribution margin. What's wrong with that statement?
Because if you have a product that has a high contribution margin for individual product, but you only sell 2 of them versus a low contribution margin that you sell 50,000 of them.
Yeah, let's say you have 2 products. Product A has a contribution margin of $2. You sell 5 of them. Product B has a contribution margin of $1, but you sell 5 million of them. Product A has a higher contribution margin. Shouldn't necessarily sell the one that has the highest contribution margin per unit. You should sell the one that has, well, I'm getting into sticky territory. Yeah, per unit of constraint is what I should say. If time is the problem, you figure out which product is more profitable on a per minute basis or a per hour basis or something. And we're going to see how that works. Rather, total contribution margin will be maximized by promoting those products or accepting those orders that provide the highest contribution margin in relation to the constraining resource. So it could be time or board feet or something. So here's an example. Ensign Company produces 2 products, and selected data are shown below. They have the 2 products. Selling price per unit, 60 versus 50. Variable cost per unit, 36 versus 35. So the contribution margin, 24 plus 15. So obviously, product 1 is more profitable because 24 is larger than 15, right? So if we can't produce as much of both products as we want, we should produce product 1 first and satisfy demand for that, And then with whatever excess we have, we should produce product 2, because we make 24 here and we only make 15 there, right? Everybody agree? Yes. I fooled you. And you'll see how in a minute. Yeah, the current demand per week in units, 2,000 each. Contribution margin ratio, 40. Where does that come from? 24 divided by 60, right? 24 divided by 60 is 40%. 15 divided by 50 is 30%. Contribution margin is higher here, 40 versus 30. 24 is larger than 15. So obviously, if you can't produce as much of both products as you want, obviously you should produce product 1, sell as many of those as you can, and with whatever excess you have, use the rest to sell product 2. Oh, here's another bit of information. Processing time on machine A1 per unit. Here, for product 1, processing time is a minute. Here, processing time is a half a minute. Oh, how does that change things? Well, you're making $24 a minute here. How much a minute are you making here? 30. But didn't we just all agree that product 1 is the one we should go with? You were shaking your head yes. Well, shaking the head counts as an audible.
She was trying to sneak.
Oh, that's it. Okay. Yeah, okay. So I set you up pretty good on that one, huh? Pretty well, I should say. Pretty well on that one. We all agreed product 1's more profitable because 24 is bigger than 15. If we don't have enough to make or to sell everything, we make as much of product 1 as we can, sell all of that. With whatever resources we have left, we make as many of product 2 as we can until we run out of resources. Everybody agreed to that. But now it turns out that 24, you're making 24 a minute here, you're making 30 a minute here because it only takes you half a minute. Contribution margin 15 per unit, 2 units in 1 minute, so this becomes 30. So it becomes 24 versus 30. Now it looks like if we don't have enough resources to produce as much as we need of everything, we start by producing product 2. We sell as much as we can of product 2. With whatever time and resources we have left, we sell product 1. So it's another one of those obvious cases that I fooled you on this time. One thing from chapter 7 that I hope you're learning here is that the obvious answer is never the right one. That's because the authors structure it that way. In the real world, sometimes the obvious answer is the right one, but not in chapter 7. The obvious answer in chapter 7 is always the wrong one because the authors are setting you up time after time. I was just going to say, what would Cindy Lauper say about all this?
Oh, I beat you to it.
You did. You beat me to it. Yeah. Yeah, time after time. So, what do we have here? Machine A1. Oh, we already explained this, but let's see what the authors had to say about it. Machine A1 is a constrained resource and is being used at 100% of its capacity. So you have this machine, you're using it as much as you can, 24 hours a day, 7 days a week maybe. There's excess capacity on all other machines. Machine A1 has a capacity of 2,400 minutes per week. Should Ensign focus its efforts on product 1 or product 2? Well, the obvious answer is product 1, but the real answer is product 2, which we just arrived at that conclusion. Ensign can maximize its contribution margin by first producing product 2 to meet customer demand and then using any remaining capacity to produce product 1. So again, contribution margin of 24 per unit takes you a minute, so you're making $24 a minute here. Contribution margin here is less, only 15 per unit, but it only takes you half a minute. So you can make $30 a minute with product 2. Therefore, you should emphasize product 2. Make as many of those as you can, as many as you can sell. With whatever time and resources remaining, you devote those to product 1. And that's basically what they say here. They should emphasize product 2. The key is the contribution margin per unit of the constrained resource. The constrained resource here is time. So you figure out how much can I make per minute. Time is the constraint, so it's how much per minute can I make. If it's board feet, it's how much profit per board foot can I make. I don't know if we'll have one of those examples, but board feet. So let's see how this plan would work. Allotting the constrained resource, machine A1, weekly demand, 2,200 units of product times the required time per unit, a half a minute, 0.5 minutes. And for product 2, then 1,100 minutes. They can make 2,200 units in 1,100 minutes. So if the weekly demand for product 2 is 2,200 units, times a half a minute each, they have 1,100 minutes to do that in. The total time available is 2,400 minutes. So 2,400 minus 1,100 is 1,300. They have 1,300 minutes to make product 1. How many units of product 1 can they make in 1,300 minutes? 1,300, because it's 1 minute per unit for product 1. And that's how they would maximize their contribution margin. So again, they have the numbers here. $1 per minute here, 1,300 units, which we did in our head, because it's 1 minute per unit. So the contribution margin in total, product 1, 1,300 units, at a contribution margin per minute or per unit of 24. So 31,200 for product 1. Product 2, 2,200 units at $15 each, 33,000. So the total would be the sum of those two, 64,002 would be the contribution margin for those combined. That would be the maximum contribution margin that they can make, because the constraint here is minutes. Questions? Okay. The reason there are no questions is because you fully understand all this, right? It's not that you don't know where to start. Oh, a quick check. It's another way to say quiz time. How many units of each product can be processed through machine A1 in 1 minute? Well, we already figured that out. Do you remember what it is? Product 1, product 2. Product 1 was 24 per minute. Product 2 was 15 per half a minute. B, yes? Yeah? 1 and 2. Because product 2 was a half a minute. So how much per minute? 2 units. This one is 1 minute. So what generates more profit for the company? Using 1 minute of machine A1 to process product 1, or using 1 minute of machine A to process product 2. So it would be product 1, product 2, both generate the same profit or cannot be determined. 2, 2, 2, product 2. Okay, we're beating this one to death, aren't we? But the fact that you aren't answering means maybe we need to beat it to death.
We absorb.
You absorb it. That it was full absorption. That's what we're doing here. Yeah. So quick check. With 1 minute of machine A1, Ensign could make 1 unit of product 1 with a contribution margin of $24, or 2 units of product 2, each with a contribution margin of 15. So 2 times 15 equals 30, which is greater than 24. Now it's starting to look like math. But that's it, right? 2 times 15 is 30. 30 is greater than 24. Determine the value of obtaining more of the constrained resource. More like time, maybe, or something. Increasing the capacity of a constrained resource should lead to increased production and sales. How much should Ensign be willing to pay for an additional minute of A1 machine time? Let's say someone comes to you and they say, I have this A1 machine. I'm going to charge you $15 for every minute you use it. Should you take the deal? I'm going to charge you 15 minutes. I have this A1 machine. You can increase your profits. It's going to cost you $15 for every minute you use the machine. Should you take my offer? $15 a minute.
It depends how much.
Yeah, it depends on what your contribution margin would be, right? If your contribution margin is positive with that, you would say yes. Yeah, we're making $30 a minute on product 2, and how much we're making on the other one, $24 a minute? So if I charge you $15 a minute to use my machine, you'd say yes for either product, right? Yeah, because your cost is 15 and you're making either 24 or $30 a minute. The additional machine time would be used to make more units of product 1, which had a contribution margin of $24 a minute. Ensign should be willing to pay up to $24 a minute, so that would be the break-even point. Yeah, this amount equals a contribution margin per minute of machine time that would be earned producing more units of product 1. Why wouldn't they be producing product 2? Didn't we already determine that was more profitable? Why aren't we producing product 2? They can only sell a certain number, and we've already hit that mark, right? Now we produce as many product 2 as we can sell, and then we start on the less profitable product. That's why we're going to product 1, not product 2, because we've already saturated the market for product 2. We have an unfilled need for product 1. Oh, quick check. Colonial Heritage makes reproduction colonial furniture from select hardwoods. Oh, tables and chairs. I didn't see that one coming. Or maybe I did. Selling price per unit. They can sell each chair for $80, each table for $400. So I know you want to divide 400 by 80 and get 5, but don't do that. You know, some calculations are meaningless, and that's one of them. Variable cost per unit. So for chairs, they can sell it for 80. Variable cost per unit is 30, so that's $50 left. They take 2 board feet to do that, and the monthly demand is 600 chairs and 100 tables. They sell each table for 400. Variable cost per unit is 200. They need 10 board feet to do that, and the monthly demand is 100. If they can only get a certain number of board feet, how should we determine how many chairs to make and how many tables to make? We would calculate the contribution margin on the basis of the constrained object. What's the constraint here? The board feet, yeah. So which is more profitable use of the board feet, the tables or the chairs? And when we figure out how much can we make in terms of board feet per chair per table, that'll give us our answer. So the company's supplier of hardwood will only be able to supply 2,000 board feet this month, so that's the constraint. Is this enough hardwood to satisfy the demand? Well, obviously the answer is no, or else this wouldn't be an exercise, right? How many board feet do we need? Well, the monthly demand, 600 chairs times 2, that's 1,200. 100 times 10 is 1,000, so 1,000 there, 1,200 there, 2,200, right? 2 times 600 plus 10 times 100. We need 2,200 board feet. We can only get 2,000. So what do we produce first? Chairs or tables? We have to figure out, calculate, which is more profitable on a per board foot basis. So let's see, the company's supplier, I guess now. Oh, well, we already did this in our heads. 2 times 600 plus 10 times 1,000. They need 2,200 board feet. That's greater than 2,000, therefore, they don't have enough to produce everything that they could sell. So the company's supplier of hardwood will only be able to supply 2,000 board feet. We've arrived at that already. So how many chairs and how many tables should they produce is the question. You can choose one and you get a 25% chance of getting it right. Or how would you go about solving this one? How do you determine the contribution margin per board foot for each of these?
Divided by the number of
Selling price is 80, variable cost is 30, so that's $50. Divided by 2, so that'd be 25 for chairs. 400 minus 200 is 200. Divided by 10 is 20. I already forgot what I said. 25? Yeah, 25. Okay, so this is 25, that's 20. So we should make chairs first. How many chairs should we make? 600. And then with whatever board feet we have left, we should make tables with the rest. And I guess the people who can't get tables will have to eat dinner on their lap, so we can sell them tray tables or something. I don't know. So that's how we would do it. So 600 chairs and 80 tables. We already determined chairs would be more profitable because it's 25 per board foot. 80 minus 30 is 50. Divided by 2 is 25. So we make 25 per board foot here. 200 divided by 10 is 20. This would be 20. So we make as many chairs as we can, 600, and then we just keep making as many tables as we can until we run out of lumber, board feet. And that would be 80 tables. So here are the numbers. Again, selling price, variable cost, contribution margin, 80 minus 30 is 50, 400 minus 200 is 200. Here, 50 divided by 2 is 25, 200 divided by 10 is 20, and then the production of chairs, you do those first because 25 is larger than 20. 600 chairs times 25, the first 1,200 board feet go to the chairs. You can get a total of 2,000 board feet. 1,200 for the chairs, you have 800 left. 800 would go for tables. How many tables? Each table is 10 board feet. 800 divided by 10 is 80. You can make 80 tables. 600 chairs, 80 tables. So if I change the numbers, would you be able to do this? Yeah. If I change the name of the company, would you be able to do this?
We went over the stuff in our data analytics class.
Oh.
Kind of, sort of.
Oh.
I mean, the same concept. Allocate your resources to the highest profit producing. And then
Oh. Somebody's infringing on my turf then, the analytics
yeah,
class?
Dr. Advar, if you want to
Oh,
get fired.
there's 2 of those. We have 2 of those.
Don't mess with Apple.
It's the business.
This is Dr. Adamar, that one? Oh, okay. Well, that's okay. She's allowed to teach accounting if she wants. It's really accounting. She might disagree with that. It's really economics. It's applied microeconomics. I mean, I'll admit it. Accounting is just a subfield of applied microeconomics. As before, Colonial Heritage's supplier of hardwood will only be able to supply 2,000 board feet this month. Assume the company follows the plan we have proposed. Up to how much should Colonial Heritage be willing to pay above the usual price to obtain more board feet or hardwood? Oh, are we talking about break-even points again? Yeah, what's the break-even point for this? 20 per board foot. We determined that before, right? 200 divided by 10, 20 per board foot. If they pay any less than that, they're making money. If they pay exactly 20, they're breaking even. Managing constraints. It is often possible for a manager to increase the capacity of a bottleneck, which is called relaxing or elevating the constraint in numerous ways, such as working overtime. If it's a time constraint, you work overtime, but then you might have to pay them time and a half, which you'd have to take into account. Subcontracting, ooh, that's another way of saying outsourcing, right? Outsourcing, subcontracting some of the processing that would be done at the bottleneck, investing in additional machines at the bottleneck, shifting workers from non-bottleneck processes to the bottleneck. Sometimes you have workers, they work 8 hours. Well, they're being paid for 8 hours, but they only have enough work for 6 hours. If you can identify some of those people, have them work on the tables and chairs for a while, a couple hours a day. Focusing business process improvements efforts on the bottleneck, make it work more efficiently somehow. And reducing defective units processed through the bottleneck. So prepare an analysis showing whether joint products should be sold at the split-off point or processed further. Here's another one. Let's say you're pumping oil out of the ground. And you make stuff into it. Gasoline, kerosene. It used to be phonograph records too. Maybe you've seen phonograph records in the museum. Those little things with grooves, and you know, if it's 33 1/3 revolutions per minute, you put music on that and stuff. Have you seen those? Maybe your parents or grandparents had some. It's made from petroleum. Some food is made from petroleum too. I can't think of what it is at the moment, but let's say you pump all this raw material out of the ground, petroleum, you make stuff out of it. You can make several things. How do you determine whether you should continue to process it, make those other things, or to sell the semi-finished material to somebody else. Depends on if you can make more money by processing further or by selling it. We have something called joint costs. In some industries, a number of end products are produced from a single raw material input, like petroleum, pump it out of the ground. Two or more products produced from a common input are called joint products. Like you could have gasoline, petroleum oil, and whatever else they make, jet fuel, different grades of gasoline, and so forth. The point in the manufacturing process where each joint product can be recognized as a separate product is called the split-off point. Oh, there's an oil well. I didn't see that one coming. Or maybe I did. For example, in the petroleum refining industry, a large number of products are extracted from crude oil, including gasoline, jet fuel, home heating fuel, lubricants, asphalt, and various organic chemicals. And the split-off point is here, common production process. You pump the stuff out of the ground, the cost of pumping it out of the ground would be the common production process. Once it's out of the ground, what do you do with it? You can process it further and make these different products. The question is, should you process it further? Well, if the revenue to be generated by selling the processed product is higher than the cost of doing that, in other words, if the marginal revenue exceeds the marginal cost, then you would do it. Otherwise, you don't. So you could have three products here. In two cases, you might process further. If the additional revenue here is 25 a unit and it only costs you 12 a unit to do that, you'd have a positive contribution margin, so you'd do that. Maybe the same with gasoline, but maybe not with chemicals. Maybe you're better off selling those chemicals to a chemical company who can do something with those chemicals. So you just compare the relative revenue to the relative cost of doing that. Oh, the pitfalls of allocation. Again, sometimes if you allocate certain costs, if they're costs that you would have anyway, you maybe should not allocate them when you're trying to determine what to do with these materials that you could develop into something else. Joint costs are traditionally allocated among different products at the split-off point. The typical approach is to allocate joint costs according to the relative sales value of the end products. Although allocation is needed for some purposes, such as balance sheet inventory valuation, allocations of this kind are very dangerous for decision-making because, yeah, you're putting fixed costs somewhere, but they had nothing to do with the actual cost. If you allocate them, maybe you shouldn't allocate them sometimes. So again, we have the option of either selling it as is or processing it further. You'd only process it further if the increase in value exceeds the increase in the marginal cost. Joint costs are irrelevant in decisions regarding what to do with the product from the split-off point forward. Therefore, these costs should not be allocated. Like if it costs you $100 million to pump out the oil. When you're trying to figure out what do we do with it now, you don't look at that $100 million that you spent to pump it out of the ground. That's an irrelevant cost. It's a past cost, a sunk cost. With respect to seller process further decisions, it is profitable to continue processing a joint product after the split-off point, so long as the incremental revenue from such processing exceeds the incremental processing cost. So in other words, if the marginal revenue exceeds the marginal cost, you do it. Otherwise, you don't. Gee, I wish they'd show us an example. You think they'll do that? Oh, not in this slide. Maybe another slide. Sawmill Inc. cuts logs from which unfinished lumber and sawdust are the immediate joint products. Unfinished lumber is sold as is or processed further into finished lumber. Sawdust can also be sold as is to gardening wholesalers or processed further into Presto logs. So here we have the two products, lumber per log. The sales at the split off, they can sell that for $140. Sales after processing further, if they invest some money and process that further, instead of getting $140, they can get $270. That's an extra $130. The allocated joint cost 176, and the cost of processing further is 50. So in other words, should they invest $50 so that they can get 270 instead of 140? Does that make sense? Would you invest $50 if you can take 140 and make it into 270? Yeah. If you can increase this by more than 50, you do it. The cost of going from here to here, from 140 to 270, the cost of doing that is 50. How about this? In order to go from 40 to 50, how much would you be willing to spend in order to go from 40 to 50? $10 would be the max, right? What if it cost you 20? No, you wouldn't do that. So you would not process the sawdust further because you'd have to invest $20 in order to increase the value by 10, going from 40 to 50.
What about the allocated joint products cost?
Yeah, forget that.
Because if you, it's misleading, so it looks like if you add the 176 to the 50,
Uh-huh.
it's higher than the sale that you generate of 270.
Yeah, yeah. For those in cyberspace, what do we do with the allocated joint product cost? Nothing. They're thrown in there to confuse you.
Yeah, that's what
Literally.
Yeah, the question is, should we spend $50 on the lumber so that we can sell it for 270 if we can sell it for 140 without spending the 50? Yes.
it'll be a straight shot, because they can just give you the answer.
Yeah, if they gave you only numbers that were relevant, it would take all the fun out of it, right? Yeah, so the question is, what about those allocated joint costs except 176 and 24? Let's forget about those for now, for this purpose. You know, when answering the question, should we process further? You don't need the 176 and the 24 to answer those questions. It costs you $50 to go from 140 to 270, so you do it. Well, 140, 270, that's another 130. Would you invest $50 to get 130? Yes. Would you invest $20 to get 10? No. You make it up on volume? That's a marketing joke. The answer to that question is no. Pay attention, these jokes come fast. So fast, too fast, I guess. Okay. So what do we do here? Oh, basically what we already said. The incremental revenue, 270 versus 140. Incremental revenue, 130 here. Incremental revenue, 10. And the incremental cost here is 50. So 130 is more than 50, so you do it. You can make an extra $80 by doing it, but you're losing 10. Invest $20 to make 10. It's not good. So you sell the sawdust to somebody, and then anyone who's willing to buy the sawdust must have some use for it, or else they wouldn't buy it. You know, you can spread it around on the ground or something, or mulch, or make something out of it. The lumber should be processed further, and the sawdust should be sold at the split-off point. What some people used to do with sawdust is, in the old days, like my mother's generation, they pack it in ice. They pack it in ice because it holds the temperature. Like that, they used to go on Lake Erie back when I was a kid. Now, when my mother was a kid, they would saw off big chunks of ice from the lake, and they would put it in storage places, and they would pack it in sawdust to keep it cold until springtime. And then these guys would go around and they'd put it in ice boxes. That's where the term ice box came from. It's like a refrigerator, except it's a box, and you put ice in it, and it's to make stuff cold. And they packed the ice in sawdust to store it for a few months. And it's a little bit of economic history there, early 20th century economic history. Won't be on the CPA exam.
No, activity-based costing, no.
Yeah, please put that on the exam. Activity-based costing, no, you remember that. Yeah, what's the abbreviation for activity-based costing? There you go, ABC. Yep. Activity-based costing can be used to help identify potentially relevant costs for decision-making purposes. However, managers should exercise caution against reading more into this traceability than really exists. People have a tendency to assume that if a cost is traceable to a segment, then the cost is automatically avoidable. You can trace something, especially if it's an allocated fixed cost, you can trace it, but it doesn't mean anything necessarily. Before making a decision, managers must decide which of the potentially relevant costs are actually avoidable. That's it. Time to crunch numbers. And we have approximately an hour to do that. Yeah. So, yeah. Let's take a look at exercise 1. This is on page 309. Page 309, exercise 1, identifying relevant costs. Again, relevant costs are costs that may be different between alternatives, costs that make a difference. The number of costs are listed below that may be relevant in decisions faced by the management of Svan AB, the Swedish manufacturer of sailing yachts. So rather than read through all those, let's go to the requirement. Copy the information above in your answer sheet, blah, blah, blah. Part 1, the company chronically has no idle capacity, and the old model B100 machine is the company's constraint. Management is considering purchasing a model B300 machine to use in addition to the company's present model B100 machine. The old model B100 machine will continue to be used to capacity as before, with the new model B300 machine being used to expand production. This will increase the company's production and sales. The increase in volume will be large enough to require increases in fixed selling expenses and in general administrative overhead, but not in the fixed manufacturing overhead. So let's go through that one first. Which costs are relevant for case 1? So sales revenue, well, that's relevant because they could increase sales revenue. Huh? There's a side conversation going on. What's going on? Questions? No? Just too much excitement to hold back? No? Oh, not too much? Okay. So yeah, sales revenue is relevant here because by buying the new machine, they can increase revenue. Direct materials, that's relevant because they produce more units. They have more variable direct material. Direct labor the same way, variable overhead. All the variable stuff would all be relevant because they're producing more units. Depreciation on the B100 machine, why is that not relevant?
Can you clarify that?
Clarify? Oh yeah, for the variable cost, if you buy another machine, you're going to be able to produce more units.
Oh.
And so the more units you have, the more direct material, more direct labor, more variable overhead you're going to have. So those are relevant numbers because if you buy the new machine, you have those numbers. If you don't buy the new machine, you don't have those numbers. If the numbers are different between the two alternatives, like buy versus not buy for the machine, then it's relevant. So any variable revenue is relevant, any variable cost is relevant. Sometimes fixed cost is relevant or not, depending, like if you buy a new machine, that would be a fixed cost. Or if you rent the new machine, if you rent, you have rent. If you don't rent the new one, you don't have, so that would be relevant there. So for part E, depreciation on the old machine, the B100, that's irrelevant because you're already using the B100 to capacity. The depreciation, whether you buy a new machine or not, is going to be the same. Depreciation on the old machine is going to be the same. So for part E, that's not relevant. Part F, book value. Isn't book value just the kind of sunk cost? Past cost, right? Sunk cost, past cost, irrelevant cost. Those all mean the same thing in chapter 7. Past cost, sunk cost, irrelevant cost. And part G, disposal value of the B100 machine. They're not going to dispose of it, so that's irrelevant, right? They're either going to buy another machine in addition to this one or not. And so disposal value on the old machine is irrelevant because they're not going to dispose of it. Part H, market value of the B300 machine, that's relevant because they either buy it or they don't.
Yeah.
And so that would be different between alternatives. If it's different between alternatives, it's relevant. So that's H. Part I, fixed manufacturing overhead in general. Well, that's going to be the same under either alternative. If they buy the new machine or if they don't, the fixed manufacturing overhead general is going to be the same. Any kind of variable stuff is relevant. Variable selling expense. If the sales staff gets a commission for each unit they sell, if you buy the new machine, they're going to sell more units. So you're going to have more commissions. So that's variable selling expense is relevant. Fixed selling expense, if there is a fixed selling expense, if you buy the new machine, you're going to have more sales, therefore more expenses. And general administrative overhead, if that machine causes overhead, which it might, then that would be relevant. Some of these are more clear-cut than others because they don't tell you all the facts sometimes. Sometimes you have to assume. But that's it for case 1. Any questions about case 1? No? Okay, let's turn to page 310. We'll read case 2, the top of page 310, case 2. The old model B100 machine is not the company's constraint, but management is considering replacing it with a new model B300 machine because of the potential savings in direct materials with the new machine. The new machine will use less materials. It'll be more efficient. The model B100 machine would be sold. So if they buy the new one, they sell the old one. But if they don't buy the new one, they don't sell the old one. So I guess whatever they could sell it for would be relevant, right? Because in one case they sell it, one case they don't. So that would be two different things. This change will have no effect on production or sales other than some savings in direct materials costs due to less waste. So going back to page 309, sales revenue, in this case, it's not relevant because sales wouldn't change. They're just getting rid of one machine and they're buying a new one. Sales would be the same, therefore it's not relevant. The direct materials, that would be relevant because if they buy the new machine, they use less materials. If they keep the old one, they use more. It's different under the two alternatives, therefore it's relevant. And direct labor, they could produce them just as fast either way, so direct labor is not going to be affected. It would be the same under either alternative, buy or not buy, so it's not relevant. Part D, variable manufacturing overhead, that would be irrelevant because they said, based on the fact situation, the only thing that changes is material, and overhead is not material, so that wouldn't change, therefore it's not relevant. Depreciation on the B100 machine is not relevant because they're going to get rid of it. Book value on the B100 machine, the book value per se is irrelevant because it's a sunk cost. But what you could sell it for, would that be relevant? Yeah, the salvage value, that's going to be a cash inflow if you can sell it. The actual book value is irrelevant because it's a past cost. Past cost, sunk cost, irrelevant cost. So for part F, book value, that's irrelevant. But part G, the disposal value, if you decide to buy a new machine, you can get rid of the old machine, so you get a cash inflow. That is relevant because if you don't buy the new machine, you won't get rid of the old one. So the alternatives are different, therefore that's relevant. Part H, market value of the model B300, that's relevant because you're going to have to pay the market value if you buy it, but not if you don't. And so there'd be a difference there if you buy it versus if you don't, therefore it's relevant. And part I, fixed manufacturing overhead in general, again, irrelevant. And part J, variable selling expenses, that's not relevant there because the, well, you tell me. I've been telling you all the answers, you tell me. For part J, variable selling expense, why is that not relevant? It was relevant before for case 1, but it's not relevant in case 2. Why not? Sales is going to be the same, right? If you buy the new machine, sales is going to be the same as if you didn't buy the new machine. The only reason they're buying the new machine in case 2 is so they use less materials. And so there wouldn't be any additional variable selling expense because sales remain the same. And part K, fixed selling expense. Again, that's irrelevant. Sales remain the same. General administrative overhead, again, irrelevant. Be the same under either case. Any questions about case 2? No? Okay. You probably want to do some number crunching, right? Let's see if we can do some number crunching here. Oh, there's a few numbers here. I wish they would get rid of this restart in progress thing here. That's so annoying. Okay. Exercise 2, page 310. Dropping or retaining a segment. Again, this segment looks like it's unprofitable. Should you get rid of it? The Regal Cycle Company manufactures 3 types of bicycles: a dirt bike, a mountain bike, and a racing bike. Data on sales and expenses for the past quarter follow. So they have a column for the total. They have a column for each of the 3 products. They have sales, variable expenses, contribution margin, various categories of fixed expenses, and net operating income and loss. Their overall income is $32,000. $17,000 of that is generated by the dirt bikes, $24,000 by mountain bikes, and it looks like they're losing $9,000 on the racing bikes. So if you're going to get rid of something, you should obviously get rid of the racing bikes. And since you're losing money, it's a no-brainer. Let's get rid of that racing bike stuff. Yes? Whenever I say it's a no-brainer, what does that mean? It's a brainer. Yeah? For chapter 7, anytime I say it's a no-brainer, it's a brainer. The authors are trying to fool you, but you're on to them. Management is concerned about the continued losses shown by the racing bikes and wants a recommendation as to whether or not the line should be discontinued. The president of the company would look at this and say, let's get rid of the racing bikes, they're losing $9,000. It's up to you to convince the president that that would be a mistake. The special equipment used to produce racing bikes has no resale value and does not wear out. So the first requirement, should production and sale of the racing bikes be discontinued? The obvious answer is yes, but that may not be the right answer. And we have to explain our answer and then show computations. So let's take a look at the numbers. They give us the answer and then they give us the reason. No. Production and sale of the racing bikes should not be discontinued. If the racing bikes were discontinued, then the net operating income for the company as a whole would decrease by $11,000. So where does that come from? Well, we have a lost contribution margin because you notice the contribution margin here in the book, $27,000 for racing bikes, and the fixed costs that could be avoided if you can trace advertising to the racing bikes. You could just not advertise those, and you could save $6,000 there. And if the production manager is assigned solely to racing bikes, you can get rid of that person and that $10,000. So you lose $27,000 contribution margin. You'd only save $16,000 in cost. So you'd be $11,000 behind.
What about the other 2 figures that were depicted in the graph as well? If you look at racing bikes, the depreciation of special equipment, $8,000.
Oh, okay. Let's take a look at that
And then
then.
12,000.
Yeah, for the depreciation of special equipment, that $8,000, that's a sunk cost, right? Sunk cost, past cost, irrelevant cost. Yeah. The fact that it's special equipment, that just sort of throws you off, right? To make it sound like it's relevant. Depreciation, special equipment. Yeah. Sunk cost, past cost, irrelevant cost. The only costs that are really relevant here are that $6,000 in advertising that are traceable, and the salary of the production line manager, $10,000. All the others you can ignore. So you just compare the cost savings. You save $16,000 by discontinuing, but you lose $27,000 in contribution margin. So you're $11,000 behind. So even though it looks like you're losing $9,000, if you got rid of that, you'd be losing $20,000. And so you don't get rid of it. And down here, they mentioned depreciation of the special equipment is a sunk cost, not relevant to the decision. The common costs are allocated and will continue regardless. So again, just like rent, for instance, the rent is just allocated among the various units, maybe on the basis of relative sales value or square footage, whatever. Usually it's relative market value. Oh, look at this. An alternative solution. Just when you thought you had all the excitement you could take, there's more. How else could we do this? Oh, look at this. Where they look at all the aggregate. I was just about to say that. What do you call this approach? It's the aggregate approach. Yes. So you can do this in 3 columns. The current total, 32,000, and then the total if the racing bikes are dropped, 21,000 there. Contribution margin 153, operating income 21, or the difference net operating income, again, increase or decrease. Difference there, 32 versus 21, 11,000 behind. So this is the aggregate approach because you're showing all the numbers. What about that first solution? What could we call that?
Not marginal, there.
The other approach, the non-aggregative, or maybe incremental approach? Yeah, incremental approach. Or differential approach. 2 names for the same thing. So the first solution, differential approach or incremental approach, aggregate approach is this one. The advantage of the aggregate approach, you can see where all the numbers are, where they're coming from, where they're going to. The disadvantage is it takes up a lot of space and there's a lot of irrelevant numbers there. You know, if you're answering the question, should we discontinue that product line, a lot of these numbers won't help you get that answer. But they're there in the interest of completeness. So the first solution is easier because it only shows the relevant numbers. The second solution, the aggregate approach, is more comprehensive. Any questions? No? You're starting to see patterns here? Are the authors always trying to set you up or only sometimes? The answer begins with A. Always, always. For part 2, recast the above data in a format that would be more usable to management and asserting long-run profitability. Well, here we have the 4 columns again, the total, and 1 column for each of the 3 products they produce. Sales for each and the variable cost and so forth. Contribution margin, and then the traceable fixed expenses to each thing. Depreciation on special equipment and so forth, traceable fixed, blah, blah, blah. You notice what they do here, though. With the common fixed cost, they don't allocate that. That 60,000, they don't allocate it among these 3 on the basis of relative market value or anything else. They just put it here in the total column. And again, 32,000 there. But by not, yeah, where it should be, by not allocating that 60,000, because if we allocated that, it could cause us to drop a product line that's actually profitable. And so you just put that 60,000 common fixed expenses there in the total column, not in the other 3 columns.
Which made that a profit of 3,000 rather than a loss of 9.
Yeah, exactly. Instead of a loss of 9, it's a profit of 3. So apparently they allocated 12,000 to that. Is that what they did there? That's what they did. Yeah, if you look at the book, page 310 in the middle, they allocated 12,000 of that 60,000 to racing bikes. So instead of a $9,000 loss, it's a $3,000 profit because they don't allocate that 12,000. Questions, comments? Yeah. Okay. Number 3, make or buy, or outsource, or not. Troy Engines Limited manufactures a variety of engines for use in heavy equipment. The company has always produced all of the necessary parts for its engines, including all of the carburetors. An outside supplier is offered to sell one type of carburetor to Troy Engines Limited for a cost of $35 per unit. To evaluate this offer, Troy Engines Limited has gathered the following information relating to its own cost of producing the carburetor internally. So they have direct materials. This is based on a volume of 15,000 units per year. That'd be 14 per unit for direct materials, 10 for direct labor, variable manufacturing overhead of 3, fixed manufacturing overhead that's traceable of 6 with a little asterisk there. It says 1/3 supervisory salaries, 2/3 depreciation on special equipment with no residual value. How does that throw a monkey wrench into things at $6? We break that into 2 and 4, right? Which of those, how much of that 6 is relevant? We're talking about either making our own or buying it on the outside. How much of that 6 is relevant for purposes of deciding should we make or buy? The asterisk says 1/3, that would be $2. 1/3 of 6 is 2. 1/3 supervisory salaries, 2/3, that would be $4. Depreciation on special equipment that has no resale value. How much of that 6 is relevant for purposes of answering the question, should we make or should we buy? Oh, 2. 2, yes, exactly. 2. Yeah, because if we make it, we have to continue paying the supervisor. If we buy it, we can fire the supervisor cold and heartlessly or transfer the supervisor to somewhere else. And then fixed manufacturing overhead allocated. So anyway, when you add this up, the total unit cost, if we make it ourselves, is 42. We can buy it on the outside for 35. We're saving $7 a unit. So the, what's the word I'm looking for? The no-brainer answer. No, she's shaking her head. Someone in the third row shaking her head back there. It looks like a no-brainer. We can buy it for 35. Why should we spend 42? Is it really that easy? You know that it's not, right? Because some of these fixed costs we're going to have anyway, and some we won't. So how should we structure this? Let's structure it. Oh, they've already done it for us. Create a differential cost, make versus buy. And again, the level of activity, 15,000 units, make versus buy. The cost of purchasing, if you buy it, would be $35 a unit times 15,000 units, 525,000. The direct materials, $14 a unit if you make it, times 15,000 or 210, and the same direct labor, variable, blah, 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 all that stuff. So the total cost, 29 if you make, 35 if you buy. Then the difference in favor of continuing to make, the difference between 29 and 35 or 6. So you're better off by $6 a unit. 6 times 15, 90,000. You're $90,000 ahead if you make it yourself. We just get rid of all those irrelevant costs. Again, only the supervisory salaries can be avoided. That other $4 out of the $6 cost you would have anyway.
So why are they giving us the problems in this format if those bottom line numbers aren't accurate?
The bottom line numbers are sort of accurate.
I mean, are we just supposed to, is this just our opportunity to learn the difference between relevant and irrelevant costs?
Yeah, that's it. Yeah, these are just exercises where you look at a fact situation and you ask yourself, what difference does this make? It's the Hillary question, right? What difference does it make? It's my attempt at humor. Yes? Yeah, you might. They might give you a fact situation like this. And I haven't looked at the multiple choice for this chapter. I go, I push a few buttons, and then the machine generates the questions. I have no idea even what the questions are. And you each get different questions anyway. So.
You know what to do.
Yeah, yeah. But has anyone gone into the quizzes for Chapter 7 yet?
No.
Oh, okay. Because I was going to ask, do they have this stuff where you have to determine relevant, irrelevant? I would say probably yes. Because isn't that what Chapter 7 is all about?
I'm just taking notice that the time there is way different from what time. 30 minutes at the top.
Oh yeah, it's forget that. Yeah. What do you have? 6 minutes? 6 minutes is enough, right? Well, you had to point that out. So now you want 30 minutes a question? You're not going to get 30 minutes a question.
I mean, but whenever we look
the minutes that it's supposed to take to
Right.
solve the problem, so.
Yeah,
In all honesty, the homework takes longer than the quizzes.
yeah.
And-
The homework takes longer than
I'm
quizzes.
like the rest of them, we need more time. Cause I'm not gonna get CPA.
I said that once.
Well, I know.
Then I changed my mind.
This is.
I was
real life.
pushed into it. I didn't have a
And
choice.
you can see, we don't, well, no person, anybody, we just didn't leave high school. We have a little bit of issue, we're a little slow.
I know about age. I know people who are even over 40. Yeah. So anyway, you're not,
You said people thought you were 40?
no, I know people who are over 40. No, I'm not giving you 30 minutes for each multiple choice. Now, the multiple choice hopefully won't have as complicated a fact situation as this one. This is, it isn't complicated exactly, it's just a lot of numbers. But, yes?
Can I point out something else? I don't know if anybody saw, like the chapter 6. Some questions, it was close to the answer, but it was not quite the answer.
I had
And it had nothing to do with the rounding. It was
No, it was
totally
all.
like,
Yeah, right.
Really?
And another-
I say 30 minutes on that problem.
It was 13,800 and something. And the closest
14.
answer to that was
Yeah,
like,
we have the same question.
yeah, did you?
14? That's what I have, 14,000. I
Oh.
took. And I
Well,
have-
after you answer it and they give you the solution, do they show you the number and does it come out exactly?
Yeah, but that's
Right,
right.
it doesn't come out exactly the same.
No? Oh,
But you had to
It's
just
not
guess
like-
the one that was
Even
closest.
if you keep the
Oh.
figure in the calculator with all the numbers, it still doesn't come out to that.
Oh.
Yeah, because I thought they were like 10 or 15 off because we rounded things and then we multiplied by big numbers. You can lose a couple, but even with the exact numbers in the calculator.
Right, it
Oh.
still doesn't
It
come
didn't
out
come
to that
out
one.
like.
So the point I was making, you go back and redo that same, and then steps to where you think you missed something. So you go from 0
That's the same thing I did.
and you go back
Yeah.
and you still
get right back over and I got the
So
same
that's-
answer, but that answer was not here.
yes, so the point I was trying to make, that's kind of confusing.
Right.
It's very different.
oh,
Because you gotta go back, because you don't know where, at what level you messed up.
Yeah.
So you
Yeah.
gotta go from, I'm just.
And it was off like about $30-something from my stuff.
oh. But was the correct answer the one that was closest to?
But then you missing the
No, but then you
No,
have.
I see what you're getting at.
Okay,
Yeah,
those,
You're supposed to have
That's-
the exact
no, no,
answer,
no.
not something that's close.
No, there was.
I took a chance, you shouldn't have to take a chance.
Yeah, we
Yeah,
can't.
all right, they should always have the correct answer, not something that's close to
Oh,
the
I
correct
thought I was
answer.
the only one that had that
Oh,
problem.
no.
No, I thought I was the only one that had that problem.
So-
I had like-
Okay, well, you get throw off, he's always saying, you round it to 2 decimal points.
Uh-huh.
And you think that when you round it to
Right,
2
you
decimal
want to get it.
that the choices they give you is gonna come out to the true answer that you have. But
Mhm.
that's not the case, this was really the closest answer to the answer that you had. And you have to go and make assumption that your answer is closer to, even though some of those answers may be close and relevant to each other, you still have to make a decision whether your answer $30 off or $40 off.
Exactly.
For one of those
Yeah.
answers. That's
Exactly.
Yeah, so, yes?
Have you ever given this exam by using the McGraw Connect before, like our exam too?
I've used McGraw Connect before, like 10 years ago or something.
Because I feel like,
This is the first semester we're using it here.
so I feel like when we have
Connect.
the opportunity to use our computers, that's what I'm super anxious about exam too, because it's paper-based with notes rather than the book. So I have an electronic copy of the book, so I can just control find, and I can do things much quicker with my computer. I have a book, I can control find things in my book, I can look for reference, I can help work through it, right? Because I'm not a subject matter expert, but I do have relevance, I understand what I'm doing, but I still look at reference. So when we have this, without the computer, if we're already time constrained with a computer that can help us, how on earth are we supposed to do in that time limit on a paper base with just notes? So I don't mind your first quiz, it was really time constrained, like literally down to the minute. But I just don't even see the practicality at all if we're gonna have the same number of questions with the same time constraint on a paper base with a page notes.
Well, it's 6 minutes per question.
I know what I'm saying,
5.
since you don't do the homework every week, you just said that you just click a button and it generates it. Like I would challenge you to try to take the final but realistically try to put it in from our perspective,
Mhm.
a
Yeah.
non-advanced.
Well, since you're challenging me, when I took the CPA exam, we got 2 to 2.5 minutes per question.
No, but you see, I think, not to be funny, but I think you're looking at it as we're counting majors when we're not.
Well, no, that's why you get 6 minutes instead of 2.5. And plus, it's open book, except for exam 2, isn't it? But, I mean, the other ones.
That's what I'm saying, exam 2 should have the same criteria.
No, we can have one page of notes.
Well,
inside.
There's sort of a rule that somebody made here. I don't know if I think it's in the business school, that 30% of the course has to be something that's not open book. No,
Well, no, that's
unless
what
it's a
I'm
text
saying.
class.
So that's what I'm saying, like, I don't mind the non-open book part, but I think if you're gonna have the non-open book test, then the minutes, the questions should be less and the minutes per is higher. You know what I'm saying? So the test itself's not the problem, not being able to have your book, it's having the same time constraint per question with less resources. If we're already barely prepared.
Yeah, I think that's maybe to see how well you know the material without looking it up.
Yeah, it's a little easier since the results going to be generating questions.
Yeah, it's going to be from the same source, so the degree of difficulty will be the same. I mean, there's a sort of offset here because I only count the top grade for each chapter in the quizzes. So you're racking up abnormally high grades there to offset what might be a lower grade for exam 2.
So would you have to look at the questions in chapter 6 before you do the exam, so we don't have this stuff on the actual written exam when you're doing it, the same off by $30–40?
Well, I'm taking the stuff from the same pool of questions. I mean, how should we solve this?
You can write it.
I can write the questions? Oh, that's so time consuming. You all get different ones.
So you don't think that we're at a disadvantage when there is not a correct answer if you're working?
Well, yeah, I'm sure there's. I didn't know about this problem until you just raised it.
Can I ask the last question?
Oh, the last question, definitely.
For me.
Oh,
Okay.
for you.
So the question that she asked, maybe you are not clear on that.
Well,
The
maybe.
people taking, like in class, they're gonna have different printout, like different questions? Or they're gonna have the
Well,
same exam?
the thing is, there's 2 different ways you're taking this exam. If you use Proctor Free, it's going to be set up one way, and if you use the UNC system, it's going to be set up another
No, I'm
way.
talking about in class.
In class.
Okay.
So her question was, the paper, like the quiz printed out, can you go over the answer, like to make sure that the correct answer is part of the selection?
Oh, yeah, I can do
That's
that.
what she was
That's
asking.
what I was asking, instead of having the issue.
To waste time.
Oh, yeah, I'll take a look at, since in this class it's going to be a paper exam.
Really, the last question, I swear, I promise. Can the in-class students opt to use Proctor Free?
Oh, good question. Can the in-class students opt to use Proctor Free? I don't think so. I think that's only set up for the online class. You would rather have Proctor Free?
Oh, yes.
Why?
You make her nervous.
I make you nervous?
I'm more efficient on a computer.
I'll wear sunglasses so you don't see I'm looking at you. And I'll spread the time equally. I'll look at everybody. You know, more people show up, the less time I'll spend looking at you. Just think of me as a drill sergeant. Except I don't yell and scream. And I don't verbally abuse you too much. No? A little verbal abuse is good, right? Because it feels so good when it stops.
Because you make.
Yeah, they used to call you other stuff. But now that they're politically correct, they just call you maggot. Okay, well, shall we go on? Did we finish number 3? I think we did. Is there more? Let me scroll some more. Oh, yeah, part 2. Number 3, part 2. Suppose that if the carburetors were purchased, Troy Engines Limited could use, oh, this is a good one, they could use the freed capacity to launch a new product. The segment margin of the new product would be $150,000 per year. So should Troy Engines Limited accept the offer to buy the carburetors for $35 per unit? Well, for part one, we said no, because they can make more money if they made it themselves. But what if, by not making the carburetor, they freed up space and they could do something else with that to generate income? Then it could be either yes or no, depending on how much income they can generate. If the amount of income they could generate by freeing up that space exceeds the difference that they would lose by making that other thing, or by buying instead of making themselves, then we would say yes. So it all depends on the numbers, how they crunch out. So let's take a look. The cost of purchasing, if they bought it, would be $525. In part one, we said we shouldn't do that because we can make it cheaper. But now we have this additional piece of information. If they buy from the outside, they would free up that space, the capital investment, to do other things, generate income, making something else. So the cost of making part one is $435. So it looks like they're behind. The opportunity cost, segment margin, is foregone by the new product line, $150,000, which brings the total cost, if they make it themselves, would be $585 versus $525. Now it changes because they can make use of that idle capacity to make something else. So this is an application of opportunity cost theory. The difference in favor of purchasing from the outside suppliers then would be 60. The difference between 585 and the 525. So even if they purchase from the outside supplier, which is more expensive, they can more than make up that loss by using the excess capacity, the freed up capacity, to make something else. In this case, because they can make $150,000. Questions? No? Okay. Number 4, evaluating a special order. Imperial Jewelers is considering a special order for 20 handcrafted gold bracelets to be given as gifts to member of a wedding party. The normal selling price of a gold bracelet is $189.95, and its unit product cost is $149, as shown below, which consists of direct material, direct labor, and manufacturing overhead. So the unit cost is $149. Most of the manufacturing overhead is fixed and unaffected by variations in how much jewelry is produced in any given period. However, $4 of the overhead is variable with respect to the number of bracelets produced. The customer who is interested in a special bracelet order would like special filigree applied to the bracelets. This filigree would require additional materials costing $2 per bracelet, and would also require acquisition of a special tool costing $250 that would have no other use once the special order is completed. This order would have no effect on the company's regular sales, and the order could be fulfilled using the company's existing capacity without affecting any other order. So some of those costs are relevant, like the $4 overhead variable and the $2 cost there and the $250 machine. What effect would accepting this order have on the company's net operating income if a special price of $169.95 per bracelet is offered for the order? They usually sell it for $189.95. Now they're going to sell it for $169.95, $20 less than usual. So should the special order be accepted? Well, we have to do the number crunching. Again, only the incremental costs and benefits would be used. I can scroll up a little bit so we get all of this on the screen. So if they sold them for $169.95 times 20, that'd be $3,399. And the variable cost per unit, 20 times 84, 20 times 45, and so forth. And then the $4 and the $2 is special costs that are relevant in this case. And then they also have the purchase of that fixed tool we don't have to take that on a unit basis unless we're looking at the unit cost. But that would only be good for this one order. So the total incremental cost, $29.50, but the incremental revenue is $33.99. So they're still ahead. The incremental net operating income would be $449. So they could actually charge a total of $499 less, or $449 divided by 20, whatever that would be, less per unit, and still break even. Any questions on that one? Comments? Notice there's basically 3 relevant costs there, right? Well, 4 if you include this. 169 versus 189, but the 4, the 2, and the 250. Anything else we can ignore? Number 5, utilizing a constrained resource. If you don't have enough resources to produce everything you can sell, then you have to figure out how can we maximize the bottom line by allocating resources. So Outdoor Luggage Inc. makes high-end, hard-sided luggage for sports equipment. Data concerning 3 of the company's most popular models appear below. So you have Ski Guard, Golf Guard, and Fishing Guard. Selling price of each and the variable cost, plastic injection molding machine that takes a certain number of minutes for each unit, and the pounds of plastic pellets per unit. So basically what we have to do is figure out, what do we have to do? If we're trying to maximize the bottom line, what should we do given this information? Figure the profit per unit on the basis of what? The constrained resource, right? There could be 2 of them. It could either be time or it could be pounds of pellets, depending on how the fact situation is set up. Do you think they'll give us both? One for part 1 and one for part 2? Would they do that to us? That would be an excellent way to do it, wouldn't it? Yeah, let's see if they do it that way. The first requirement, the total time available on the plastic injection molding machines is a constraint in the production process. Which product would be the most profitable use of this constraint? In other words, how much could they make per minute on each of the 3 products? Which product would be the least profitable using that constraint, using time as a constraint? So we have to figure out how much can we make per minute for each of these 3. So we have the selling price minus variable cost equals contribution margin for each of these. And if it takes 2 minutes for each Ski Guard, 140 divided by 2 is 70 per minute. 160 divided by 5, 32 per minute. 200 divided by 4, 50 a minute. So we take the largest of these 3. 70 is larger than the other 2. So the one we should do first is Ski Guard. When we make all the Ski Guards that we can sell, the next one would be Fishing Guard. If we still have time left, what do we make next?
The
Golf Guard until we run out of time. So that would be it. So again, we figure out what's the most profitable thing to make on the basis of whatever the constrained resource is. In this case, it's time. So we figure out how much can we make per minute. What if it were pounds of pellets? If we can only get so many pellets, we make the product that gives us the most profit per pellet. Okay. That's it for part 1. For part, well, if the constrained resource is time, we would choose Ski Guard.
No, I know that. But you just, well, never mind.
Oh, which would we choose, time or pellets? It would be up for us to choose.
Yeah.
Yeah, maybe we don't have enough time. Maybe we don't have enough pellets. They'll tell us, which we don't have enough of. For part 1, we don't have enough time, so we figure out how much can we make per minute. Part 2, the severe shortage of plastic pellets has required the company to cut back its production so much that the plastic injection molding machine is no longer the bottleneck. Instead, the constraint is the total available pounds of plastic pellets. Can you say that 10 times real fast? Pounds of plastic pellets. Which product would be the most profitable use of this constraint. Which product would be the least profitable use of this constraint? So if you can't get enough pellets, just like before we couldn't get enough lumber, this time we can't get enough pellets. What color should those pellets be? Purple, right? Purple plastic pellets? Yeah, painted purple plastic pellets. Yeah. So we use the same process. The selling price per unit minus the variable cost leaves us with the contribution margin. And then this one uses 7 pounds of pellets of the painted purple pellets, prime purple pellets. So 140 divided by 7, 20. Here they make $20 per pound of pellets. And here 160 divided by 4, 40. 200 divided by 8 is 25. So they make the most profit on golf guard, 40. And when they make all of the golf guard that they can sell, the next thing they use the pellets for is fishing guard. And when they make all the fishing guard that they can sell, with the remaining pellets, they use that for ski guard. So I think the reasons the authors gave us this particular exercise is to emphasize the fact that when you have a constraint like this, you figure out what's the most profitable per minute, per pellet, per pound, per board foot, whatever it is, based on the constraint factor. Whatever the constraining resource is, you figure out what's the most profitable, and then you can maximize the bottom line by doing what we just did. So. And then the third one, which product has the largest unit contribution margin? Why wouldn't this product be the most profitable use of the constrained resource? So the fishing guard has the largest contribution margin, but again, when it's a constrained resource, the largest contribution margin is not relevant, right? We have to figure out how profitable per minute, how profitable per pound of pellets or something. So the fact that one contribution margin is larger should not enter into this at all. It's maybe nice to know, but you can't do anything with that information. So. Questions on number 5? No? Okay, number 6, managing a constrained resource. Portsmouth Company makes fine colonial reproduction furniture. Upholstered furniture is one of its major product lines, and the bottleneck on this production line is time in the upholstery shop. Upholstering is a craft that takes years of experience to master, and the demand for upholstering furniture far exceeds the company's capacity in the upholstering shop. Information concerning 3 of the company's upholstered chairs appears below. So they have the recliner, the sofa, and the love seats, and they have the selling price per unit, variable cost per unit, and then the time required to produce 1 unit. What do you have the urge to do now? 1,400 minus 800 divided by 8? Is that what you want to do? And then 1,800 minus 1,200 divided by 10? And then 1,500 minus 1,000 divided by 5? You see where we're going with this, right? It's getting sort of easy now, right? You figure out the contribution margin, then you just divide by whatever it is, hours in this case. So the first requirement, more time could be made available in the upholstery shop by asking the employees who work in this shop to work overtime. Assuming that this extra time would be used to produce sofas, up to how much should the company be willing to pay per hour to keep the upholstery shop open after normal working hours? Well, this is a nice little twist. It's like another way of saying what's the break-even point, right? How much should we pay these people? Could we afford to pay them time and a half? Maybe even more than that, or maybe not. So let's take a look. The selling price, again, for the sofas, we sell them for $1,800. The variable cost is $1,200, so the contribution margin per unit is $600. If it takes 10 hours to produce 1 unit, that's $60 per hour. So if we pay them anything less than $60, we'll increase the bottom line. It's nice when you only have a few numbers to work with and when you use them all, instead of trying to figure out which numbers can I omit. So, and we can do this with all 3 products, but I don't think there's any need to. Any questions about part 1? No? Okay. Part 2. A small nearby upholstering company has offered to upholster furniture for Portsmouth at a fixed charge of $45 per hour. Well, it looks like it's costing us $60, so if they're going to do it for $45, we should obviously take their offer, right? It's another one of those no-brainers. You guys don't trust me anymore. You do? It's just not in class, is that it? Yeah. I mean, 45 is better than 60. If it costs us 60 an hour and we can get it for 45 here, we're saving $15 an hour. It's obvious. It's a no-brainer.
Unless some of those fixed costs are inappropriately distributed.
Oh, yes. If some of those costs are inappropriately distributed, then we have to do a more complicated calculation. So what else do they have to say? The management of Portsmouth is confident that this upholstering company's work is high quality, and their craftsmen should be able to work about as quickly as Portsmouth's own craftsmen on the simpler upholstering jobs, such as the love seat. Should the management accept this offer? Well, let's look at the numbers. This is so, as you might expect, to answer this question, it's desirable to compute the contribution margin per unit of the constrained resource. So for recliners, 1400 minus 800 is 600 divided by 8 is 75, and 60 and 100 and so forth. So the offer to upholster chairs at 45 should be accepted. That's recliners is the kind of chair, more so than a love seat or something. Okay. The time would be used to upholster love seats. If this increases the total production and sales of those chairs, the time would be worth $100 per hour. Net gain of 55. So they're only charging you 45 and you're getting 100, you're 55 ahead. If love seats are already being produced up to demand, then having these chairs upholstered in the other company would free up capacity to produce more of the other 2 chairs. In both cases, the additional time is worth more than 45. So this is, that really was a no-brainer. Just when you thought every no-brainer was a brainer, they give you one that's a no-brainer. That's because we're not reallocating any of these costs. They didn't tell us what other costs we might reallocate, so they're just playing with your mind, I think. That's what they're doing. Did it work? Yeah. So now you really don't know what to trust, right? You have to just crunch the numbers, which is, I think, what the authors want you to do anyway. Just, don't take the obvious answer. Judging from the response in the crowd here, it looks like it's time for a break. Is that what you're saying? No, it's not? Break? We're going to take a break in here. Yeah, you can take 15 minutes off on the weekend, right? Okay. Well, we covered a lot of material. Yeah, you notice we can never cover it all because there's just too much good stuff. But, okay. So this was a useful exercise, I think. So now we can take a break.
Until next week.
Yeah, until next week. Oh, Chapter 8, Capital Budgeting Decisions. That's another good one. So much good stuff, so little time. Oh, I keep forgetting the book. Yeah, you're officially here.
Yeah, but then I got to consult anyway. All the way from Charlotte.
No, this week is a big week for me.